Hello and welcome to Simplicity in Stocks. Good businesses do not always reward shareholders immediately. They often pass through phases of market indifference while continuing to strengthen their operations and generate cash flows. However, over time, stock prices tend to follow earnings. The companies in this video share this characteristic. The businesses are reasonably strong and growth drivers are visible. Yet, their stocks have delivered little over the past 3 years. Please note, this video is for information purposes only. It's not a stock recommendation and should not be treated as such. There is no opinion or view on any stock covered herein. Container Corporation of India. Container Corporation of India, or CONCOR, operates quietly in the background of the Indian economy, moving containers rather than grabbing headlines. Over time, businesses like CONCOR tend to compound steadily, even if the stock price occasionally does not follow along. The company's operations have held up reasonably well over the last few years, but investor excitement has been hard to come by. In Q3 FY26, sales grew about 5% year on year with a 22% EBITDA margin. The company has increased its FY26 capex by 23% to 10 billion rupees, largely toward containers and rolling stock, preparing for higher freight movement. The management has a volume growth guidance of 10% in EXIM and 20% in domestic. Looking ahead, the dedicated freight corridor DFC should bring more traffic, which may translate to better realizations. Tata Chemicals. Tata Chemicals is a large global soda ash firm with a diversified chemicals portfolio. The company's balance sheet position is comfortable. Capacity is being added as per schedule. Long-term demand drivers such as solar and EV remain intact. Yet, the near-term market narrative is dominated by weak realizations. The past year has been a reminder that commodities do not move in a straight line. In Q3 FY26, sales declined about 1% year-on-year as lower realizations offset higher volumes. The EBITDA margin slipped to 9.7% due to subdued pricing and a sharp fall in US profitability. Oversupply and muted demand kept global soda ash prices under pressure. The demand environment remains tepid in the near term, and the new global capacity is expected to keep prices tight. Beyond the short term, however, demand is expected to grow. The company is investing through the down cycle, but with some restraint. The board has approved rupees 5,150 million for a 210 KTPA iodized salt facility, rupees 7,750 million for a precipitated silica plant, and rupees 1,350 million for dense soda ash capacity. The company's acquisition in Singapore should double its bicarbonate capacity from 60 KTPA to 120 KTPA, adding higher value products to its portfolio. The management has held back expansion in weaker markets, signaling a preference for disciplined growth over aggressive capacity addition. Devyani International. Devyani International is the largest franchisee of Yum brands in India. It's among the largest operators of quick service restaurants in the country, operating KFC, Pizza Hut, and Costa Coffee stores. The company operates in a business where growth is visible, yet it's the consumer who decides the pace of purchases. And lately, that pace has been weak. And that is clearly reflected in the company's stock price. In Q3 FY26, revenue grew 11% year on year, led by 12% growth in the India business and strong traction in owned brands. EBITDA margin fell to 15.8% as higher employee and other expenses offset the gross margin gains. Store additions drove growth, even as same-store sales and average daily sales for core brands remained negative. The company's short-term priority is a repair rather than expansion in parts of the portfolio. The management has initiated a cleanup of loss-making Pizza Hut stores, but the turnaround is expected to play out over several years. The company's Skygate portfolio has reached break-even at the operating level ahead of guidance. The proposed merger with Sapphire Foods is on track, but the roadmap ahead will evolve over time. Aditya Birla Fashion and Retail. Aditya Birla Fashion and Retail is attempting something few apparel companies manage successfully. It's building a house of brands across various price points while simultaneously investing in newer engines of growth. While the company's business is expanding, consumer demand has not picked up strongly, and this is reflected in the stock price. In Q3 FY26, revenue grew about 8% YOY, while the margin improved to 13%. The ethnic wear business grew about 20%, helped by festive demand. The TMRW House of Brands platform grew 29%. Luxury retail also delivered double digit growth. However, Pantaloons revenue slipped about 2%. The management has pointed to calibrated investments, operating efficiency, and profitability improvement rather than rapid expansion. Westlife Foodworld. Westlife Foodworld holds the master franchisee for McDonald's in West and South India. It operates 458 restaurants in 73 cities and is targeting 580 to 630 outlets by 2027. The company's business model is to get consumers through the door and keep pricing stable. The challenge, however, is that eating out is among the first expenses that households postpone. In Q3 FY26, revenue grew a mere 2.6% YOY, while EBITDA margin slipped to 14.6%. Same store sales declined 3.2% due to lower eating out frequency. The management has said hyperlocal marketing, digital engagement, and app driven ordering has helped to contribute to 6% growth in the on premise business. The company's expansion continues despite an uneven demand environment. Stock prices can stay indifferent for long periods, but companies that generate steady cash flows and maintain balance sheet discipline tend to endure. Investing is largely about separating price from value. Markets often get distracted in the short run, but business strength reveals itself gradually. The two may diverge for a while, but they don't diverge forever. For investors, patiently focusing on financial strength, corporate governance, and valuation discipline, and the margin of safety is the right thing to do. Stock markets eventually recognize consistency. The challenge is staying invested until they do. Happy investing.